Stuart here again. It's August the 1st, Friday, August the 1st already. 7 months have gone. I hope you are 7 months through your trading year and you're 7 months towards your target of the year. We've had a good week. I'm going to close the week today, but I've got no open trades. I have got open trades, but it doesn't look like they're going to get closed out. But I'll wrap up July, including today, basically. We start August on Monday. So I hope you're all well. We've had a really good first 6 months. July's been really positive as well. Or positive rather than really positive. Obviously, August is the summer holidays, lull typically, but not necessarily with this current administration. So obviously, it's tariff day as well. It's on-farm payrolls in a little over 5 minutes, and the dollar has had a great run here. Just got there is the euro here on the hourly chart. There's that big 118 level we would look like we were going to get to. Back here on the 24th of July up here, and consolidated at highs, and the big break of the giving way of the 50 period moving average. First attempt was here into 117. We bounced off that here 25th of July, and then the second half, the second 2 weeks, the final 2 weeks of July is really unwound the dollar short. So we've been particularly, we were short earlier in the week, but we've come down here and see the 4-hour chart as well. If we got the time frames, the trend is very much still in play. You can see the 4-hour they're bouncing, as we said, into the 114 zone here, into this cluster zone here from back in June. Down, and the daily has also rolled over. So is the dollar going to have as good an August as it had July? Possibly, probably not, to be honest, but who knows? Let's not count our chickens. Some monster days in the last week or so for the dollar, particularly on the 28th there. At the beginning of the week. So anyway, let's have a look at what we've here for many people's key trading period of the entire month. Sometimes I don't know why, but some people do hail this as the biggest potential trading impact. Obviously, volatility can be high. It's unlikely unless we get some blowout numbers today, either to the upside or to the downside. We shall see. So the headline number here on our calendar here from investing.com is 106,000. Bloomberg have it around about 110,000. The Reuters poll also has a consensus around about 110,000. We had 147,000 last month. See what those revisions are like. Earnings have continued to hold up really quite strongly, just under 4% at 3.8%. They're expected to tick up a bit. The average work week also holding up at 34.2 hours. The unemployment rate 4.2%. That's what many analysts are looking at this week, this month, I should say. Just check if we've got any comments, got no chats, and hopefully you can see all that. You have to realize I'm my great big head here is in this one as well. But we'll when we bring the charts up, I'll make myself a wee bit smaller again. What was I saying? Yeah, unemployment rate 4.2%. This ticking up significantly, i.e., over 4.5 or 4.4. That would freak things out a bit. But at the moment, it's all sort of, the argument that the Fed have made about wait and see, pause, ignoring Trump's administration pressure to do that, saying, obviously, Trump and himself personally said, inflation has gone away, it's non-existent. If it comes back in 6 months' time, all well and good, put it back up. But Powell is resisting all of that. Obviously, he had those two dissenters earlier in the week. That probably, as I said yesterday, probably for more political reasons than economic reasons, to be honest. But who knows? I'm putting words in their mouths now as they play for positions in the new Fed once Powell is gone next May. But undermining the head of the central bank, the independence of the central bank from October and September, which is what they're talking about doing. It just undermine, confidence in this, in the credibility of Trump's policies. However, it is, as I say, it is trade tariff day. The one that caught my eye this morning was the Switzerland, 39% tariffs on exports from Switzerland to the United States. So cuckoo clocks, Swiss cheese, Swiss watches, obviously, and everything else Swiss. Mont Blanc pens. Love Mont Blanc pens. Who loves a Mont Blanc pens? One of my favorite investments, Mont Blanc pens. All of those, Mont Blanc perfume, all of those will be getting hit with 39.9%, 39% tariffs. Where he got 39% from, I don't know. 39 steps, who knows. His nearest neighbor to the north, Canada, 35%. There's been a big fallout between Carney and Trump. There, Carney's dealt with it initially by standing up to Trump politically. How he goes forward from here, we shall see. Trying to divest away from the US to other nations. It's a long haul, but anyway, Trump's playing hardball with Carney. Different, not extremes of the political spectrum, but different views on the world, certainly in the big picture. Anyway, non-farm payrolls, the jobs report out of the United States, very, very key for many, many traders. 2 minutes to the bell. Let's have a look at the charts as we've seen here. Euro down at 114 from this spike. Literally, like just over a week ago when we were trying to get to the 118 in the channel, as we said last week. We were waiting for this, and as we said last week, as we know, history shows us, the break can be quite significant. And we broke that channel and all the way down to the bottom of the next channel, which is 114. So this is our big support area now, 114. If this gives way, the May 24 low here at 112.65, and then 112 itself, another 200 step down before we next get some sort of pivot areas, some support areas. So can this big move we've seen in the dollar this week be continued? Again, I'd just question it, but as a trend following trader, I don't really care as long as I'm on the right side of a trend move. And we caught this entry on the here on the 28th after the big move, or just ahead of the further move down during the day. Initial target was taken out. We've still got 20% risk out there, and our stop loss now is at 114.48 from earlier in the week. If we get a big surprise today, that could get taken out, but we're above the 50-hour moving average, as with most of the other dollar long positions that we've got. And I know some were taken out. Yen and Kiwi were taken out. We talked about that yesterday, didn't we? So, but we're still short. And we'll see. There we go. The data must have dropped. Let's just tip this down to the 5 minute. It's dollar and negative, so perhaps that number is strong. Let's have a quick refresh of this chart. We'll get all the details here once it loads. And here we are. Let's just do today. Let's cut out everything else, all the rubbish. We'll come back to what's gone on this morning earlier. So earnings hotter than expected. Weekly hours worse, also hotter than expected. Government payrolls declined. Manufacturing payrolls declined again. They won't like that. Farm roll 73. That's fine. Private payrolls 83. That's a bit weaker. So headline has missed quite significantly at 73,000 from 110,000. I say was the consensus 106,000 here. Last month has been also degraded from 147. Look at this number here, guys. 147,000 to 14,000. That is pressuring the Fed to perhaps do something now. Non-farm payrolls, private payrolls 83 from 3 last month, which is downgrade. So lots of revision here. Unemployment, the U6 is back up to 7.9%. The headline has remained at 4.2%. This is those of you who follow me for any length of time know that I'm really quite interested in the U6 number because it's a wider measure of unemployment. It captures more of the part-time, full-time combination of employment. So 7.9%, just within a smidge of 8% on the U6 measure. So clearly, the immigration crackdown, the migration crackdown, call it what you will, is having an impact. Jobs have missed significantly at 106,000. The big surprise is the revision from last month, and there'll be some some significant explanations of that as we go on during the day, but that's quite a significant miss. So the headline number has come in at 73,000 from 110,000. And remember, last month, that's a huge revision to 14,000 from 147,000. So, excuse me, hence the massive move. So we've seen in the euro. So let me just get myself a wee bit smaller. We can see the bigger charts and see where we go from here. But it's one of those days, guys, where perhaps you should have had trading and news. I mean, if you'd captured that long, all well and good, but that's a 100-point move. Yeah, you can see that really clearly there. A 100-point move on the non-farm payroll numbers. A huge surprise for payrolls. Let me just type that into our Discord group for those that aren't here watching me. Massive revisions for NFP last month sees USD lose, Euro USD lose over 100 pips, Euro USD tank. Surge, I think is the word, isn't it? Surge from 114 to 1.15. There we go. That's huge numbers. I'm getting my my Twitter account is going mental. My phone's going off. So yeah, huge revision, guys. So 115.15, and again, I was saying yesterday about fading the news, but this is a distinct possibility for fading the news. So those of you that can't, I've got standard accounts and you can't trade during the major news. Don't panic. You haven't missed anything. I know lots of people. Oh no, I've missed this big rally. Let's see where this fades, because that's a very big reaction. The details will be explained, but that is a very big surprise for the markets on that one. So payrolls rise 73,000 compared to 110,000. Employment rate remains steady, which is what lots of people were focusing on. So there might have been some other news over what's going on. Greer, the chief negotiator, has just been on Bloomberg talking about more deals to come, but so yeah, I mean that's quite likely given that the deadline has slipped a couple of days. That's classic sort of Trump negotiation techniques, isn't it? The deadline's today, but we'll let it roll over an hour or two. Probably something for the Indians is what's being considered. Canada might come back with something, but he's playing hardball. Mexico got away with one. They've done a deal with him as well. So the Mexico situation is much brighter than they anticipated. But there we go. 5 minutes is now up. Are we gonna fade this? Well, if we hold 115, that's looking very positive. But there should be some sort of balancing up on that. So just see if it follows through. But huge news. That's the biggest non-farm payroll move we've had for many months. I will have to, probably years in fact, I will have to go back and check all the details on that to let you know on that. But it's still there's the first 5 minute candle. Actually, let's go down to the 2 minute candle. That's the one that our rules apply. So there's your no trading from here, and that's 32. So that's the 4 minute window, these two candles here, and still, even if we bought there, that's still positive because we're over 115. So see where that goes from there. My next line here on this high time frame chart was our target from the 28. So our stop loss, which I just said, we looked a bit tight. That's been taken out. We probably won't have been filled at 114.49. I'll see what my trading platform actually got me in or out at. Obviously, the slippage around non-farm payroll is always a bit iffy. Simply because of the move of the market. And that's a great example there. If we go down to the 1 minute chart, guys, or even the tick chart, we can't do the tick charts here. Look at this massive move here on as the news breaks. So 1, 2, 3, 4, 5. There we go. See what I'm saying about fading it. See how big the internet and the subsequent candles calm down. So the a bit like a firework flying up. It's running out of steam. It cools a bit here as it gets over 115, holds above it, and then it gets another breath of life. Perhaps that's at the next resistance, 115.45. Just happens to be the target level I had before, but that's definitely lift. We're at 115.25, so we're still moving higher. That's quite a significant move. You would expect yields to have fallen on that. So dollars fallen, yields have fallen. Stock markets may have picked up on that. We just click to the these all-time highs we've seen. There we go. Stock markets here. We should take this for the 5 minute and 1 minute one's a bit squiffy for stocks. But there we go. We've been down this morning. We've been down the last 2 days. There's the end of the month yesterday. So we've been down all day. Day low was here at around about 12 o'clock. We went, interestingly, tech stocks have bought all of that back. So we weakened on the data, and now we've turned around and gobbled all that up. S&P is a similar sort of pattern, and the Dow probably performing better. Indeed, it is. There it is. It's just up. So this big move down we've seen in expectations for a rate cut in September may be impacted by this revision. The details I can't see, but it looks like, you know, that's pushed out, and October is when the first cut is coming. Yeah, future. I'm just looking at here. The cash futures are down 1% on the S&P, 1.2% on the Nasdaq 100, and 2.4% on the very, very rate sensitive small caps, the Russell 2000. I'm just seeing on my Bloomberg feed here. So yeah, stocks down again. If we just quickly just do the hourly chart, you can see we've been down all into the end of the month, and then down again on the end of the month yesterday. So we'll see where that revised. Obviously, we got these all-time highs. I just got the Nasdaq still. There we go. All-time highs just yesterday, intraday, 23,700 plus, and then we cashed in, basically, is what's happening on the month of July there. So had a fantastic run. Further weakness today, so we're trying to find some sort of level, and there you are. Look at where we are now. We're right into this. This is obviously the hourly chart, but we're into these sort of pivot areas here, turning areas, turning points on the Nasdaq 100 at 23,000 on our derivative chart here. So stocks continue to lower, and the dollar weakens. So let's just have a look at the others. Aussie 64, 65, but still a long way from 65 to the upside. A lot of my long position euros, so these are all have been taken out on my trading platform. I said I had 20% left on all the positions. I will update everything later on today to close out the week and the month of July for me as well. I know I haven't updated even. I don't think I updated last week actually on the Discord group, but they will have all been taken out as the dollar has reversed significantly on that big surprise in non-farm payroll. So let's just have a look at it again. Across the board, basically, earnings stronger than expected. Monthly in line at 0.3 of 1%. Stronger work week by 0.1 from 0.3, but that was a bit of a surprise. It's been fairly constant, that. A decline in government payrolls, which is what Trump was wanting. He didn't like this rise, but look at these revisions. This is what's really spooked the market. Payrolls had gone up last month, 73,000 government employees. That was technically that's not such a surprise, because it was to do with the teachers at the end of their academic year. So that wasn't too much of a surprise. This is more back to where we were before the 10 and 11K in April and May numbers. Manufacturing payrolls continue to be very, very disappointing. This has got bigger. Remember, it's the manufacturing they keep banging on about with these goods tariffs, bringing good high quality manufacturing jobs back to the US, because these companies have to now open factories, manufacture in the US. Obviously, it's too early for this to be impacted, but it shows the decline. And this is another as we've been saying, remember what the PMIs have been showing us globally as well. It's not, I mean, it's not just a US issue. You know, manufacturing is still very, very sluggish, still in recession, and this is what this is telling us. So stuff is not being made and not being bought. The headline, significant miss. So 110,000, I know it says 106 there, but 110,000 was the consensus on the Bloomberg and the Reuters polls. And to come in some 40,000 less than that was significant enough. But the fact that the revision from last month has come down from 147,000 jobs on the initial print for June for new jobs in the United States is what the payroll said officially last month. This month it's only 14,000 once they revised it. So there's clearly some calculation here, or there's the impact of the migration policies, the people that perhaps are working that shouldn't be working, cash in hand type works that aren't registered, have been registered or not been registered. It's something in there somewhere. There's some definite detail in there. Markets hate uncertainty. These are uncertain numbers here, and hence we've got a weaker dollar on the back of it. Participation rate also weaker than expected, even though weekly hours actually went up in the opposite direction. Private payrolls missing as well at 83, but much closer than expectations. But again, look at that revision from 74,000 to 3,000 for this month. Big uncertainty is what's that saying. That plays back into the cautious step-by-step data dependent. Remember, we said it again this week, a data dependent Fed. That data is not suggesting we're going to cut anytime soon, and therefore we're pushed. The September rate cut has probably disappeared altogether. I'll bring that up in a minute and see what. Let's have a look. It should have. Whoops, I didn't mean to do that. Never mind. So September 17th, still 40. So that has updated. That's 44% rate. So look, rate cut. So still 44% chance of it still being where we are now in September. 55%. That hasn't updated, has it? I don't think from on the back of that data, if I'm correct. 50 hours come back. Yeah, it's changing actually. So it's changing. Yep. So a month ago, 73% chance of it being cut. It's now only 50-50, 52% chance of a rate cut in September. So it's pushed off the tail. But definitely, I mean, October will be rammed at 100%, I would guess. Obviously, this is internet, it's slow, it's free, so it's not real. Still only a 50% chance of a October cut, a 27%, 28% chance of a full 50 basis point cut by October. So yes, you can see it's only updated at 7 as of 7:30. So probably it hasn't updated, had the full influence of the non-farm payroll data. Anyway, let's get back to what's happening in the market. So dollar has weakened significantly, having had a really good run. So what does that look like in the scheme of things in this rundown or the run up for the dollar? So we are still, even with the reaction to the non-farm payroll, it's still had a strong week. The dollar, obviously, given a lot of it back on that news, but tried again yesterday. See up here. So some clear areas in play now. So 65 looks a stretch too far for the Aussie to come back to there, but 64 was a stretch too far to the downside as well by the looks of things here. So dollar CAD 138, still holding the key 138 level on that data. So Canadian dollar obviously getting the loonie getting impacted from the 35% tariffs on Canadian imports, even though there is the North America agreement, the MSCA or whatever it's called now. So big impacts on currencies and the yields curve. The yields also come down very significantly. I'm just looking at the 30-year here on the Bloomberg. So it's gone from 4.942 to 4.840. That's a huge move on the yield curve. So big miss for non-farm payroll. Swissy back to 80.70. So we got as high as 81.70 this morning. So again, it's a full haul numbered back to 80.70 there as well. So watch that one, because that's it's the best performing of the major currencies against the dollar this quarter. But obviously that announcement, the 39% tariffs for Swiss goods away on the Swiss franc as well. Yen 148.88. So we were 140.50 had been breached. 152. Sorry, what am I talking about? I'm talking rubbish, aren't I? Sorry, yeah, 150 had been breached. Yes, of course, I had what I'm talking about. So we've given that back up now. Dollars crashed back through there. So for one whole day, we were over 150. It looked very significant. Let's see where we finish today. The 20-day, it's still, as I said, against the other, it's still very well bid. It's still holding up 147.60 before this went short again. So big check out, lots of stops getting taken out. All my long positions, dollar will have been taken out on that non-farm payroll data. You know, that's the risk of having stuff open in these volatile moments. Yeah, and that was a major surprise. I was saying at the beginning, it didn't look like it was all going to be just another data number, but there we go. The dog days of summer for August kick off in exactly the opposite of that, high drama with a big miss for the payrolls numbers. Kiwi 59.18 from a low this morning of 58.60. So again, dollar weakening back over the 59 area. Again, far too early to tell a rally back to .60, but .59 has been recovered on the non-farm payroll data. Euro we looked at, we're still going 140. So that first target we've got to long. Remember we were looking at that on the 5-minute chart. Our target from earlier, the 115.45. So I'd be happy to close that out on that. And again, guys, you know, even if, you know, actually let's do the 2-minute. I know I went on about this yesterday, didn't I? Because a lot of you are get your knickers in a bit of a twist about not being able to trade the news because you don't want to pay more for it, on your account. But look, this is a 2-minute time frame. So the rules say for a standard account, guys, I did it yesterday. Let's do it again today. So that's 28. So you're not allowed to trade then. And there's 32. So that's when you could have vertical. There we are. Not allowed in that window there. So you couldn't have opened a position here. Here you'd have probably looked at being short, so you'd have been stopped out anyway. If you'd had a stop loss, ratcheted through. So you come at the end of this candle here, 1332. What am I doing? Well, as we said at the beginning of the video, you know, it looked quite strong, looked to fade this potentially, but it didn't happen, did it? We had 2 consecutive candles to the upside. We held the 115 level. The fading wouldn't have played out, but we'd have gone long because the fade hadn't worked. And where would we have looked? Well, we looked for previous levels on our chart, our lines, and our line was at 14 at 15.45. So even if we hadn't got in immediately, we'd got in there on that first downset. We still would have, you know, bagged at least 30 pips on that on this major move. Somebody will say to me then, yeah, but if I go back, let's go back to the minute time frame. Yeah, but if I'd got in here, Stuart, as immediately as if it'd come out, you know, I'd have got all of this. Yeah, well, yeah, you're right, but you would have probably got out at 115 and then perhaps got in and got back out. So yeah, all well and good, you've traded the news that way, but it's just because it's continued to run. It hasn't yet declined, and we are still relatively early days. It's still only 20 minutes after the news broke. And we're still going higher, so the cooling hasn't started yet. So again, just sit on it and add to your position as it continues to go in your direction. That's the art of trend trading. But as you can see, the indicators are all out of the window simply because the huge reaction we've had, and this is literally the 1 minute time frame. So the 15-minute, let's just go up the trading time frames. So the 15-minute trader has just had one candle complete, and what a monster candle complete. So he would have been happy to enter here. Significant break of 115 and an initial entry there at 115.30 for the 15-minute trader. The 30-minute trader, the candle is yet to complete, so he technically shouldn't have done anything, but huge bounce on the revisions. It was those revisions that have caused a lot of the issues around their non-farm payroll data. Okay, so I wasn't expecting that to be as exciting as it was, but there we go. That's the Forex market. Crypto, what's Bitcoin done? 115. Bitcoin has moved lower here on the data, and it's crude. It obviously it's low, had been moving lower, and has continued to move higher on the very little Bitcoin direct impact there. It started to move up and continue to move up on the weakening dollar, so 115. But we had been as low as our low today. Here this morning in early European trades, we went down to 114. That's interesting. That weakness has continued, interestingly. So let's just have a look at what that's looking like on our daily time frame. So there's that. We were talking about this last week, weren't we? About this potential divergence showing up on the indicators, and that's happened into the end of the month there, hasn't it? So we have actually moved lower, and 114, interestingly, tested 114,000 tested on Bitcoin. So we are under the 20-day moving average at the moment. So that is suggesting a bit more weakness to come, and 112 is the next support area for Bitcoin. So see how that plays out for the rest of today and over the weekend. See if there's any return for the dollar today on the back of that news. Gold should have come back to life on the weaker dollar. It has. So again, we've like we had last time, the breach of 3,300. It was short-lived, or appears to be short-lived. 1 day closing under it, and then back up and held it for the best part of the month, and then another breach, similar sort of breach on Wednesday, and couldn't recover the 3,300 handle yesterday. So it's suggesting still some more weakness to come. However, the payrolls numbers have turned that back on its head. So all this data deluge we've had this week, all being assimilated, all being analysed. 10-year yield, I'm just flashing up here, 4.2749, 4.2749, down nearly a whole 0.1 on the payroll jobs data. So yeah, September looks like it's definitely getting kicked out the window, and we are not having any rate cuts until October, given the pickup in consumer inflation data we've had this week as well. So gold, where are we technically? Well, there we go. We're right into this key resistance area that we talked about earlier in the week, the 3,345 area, where the 50 and the 20-day moving average sits. So again, it still remains quite weak. A break above this area, 350, 360, would look okay. Still not massive trending movement there on the gold market, but clearly buys at 3,300 still during this summer. We get into September and October. It may be getting tested again. We may be moving lower, or indeed we may be moving to new all-time highs, depending on lots of the geopolitical situations which remain unresolved, from Gaza to Iran to Ukraine to all these ongoing issues remain full tilt as far as the markets are concerned. So gold currently 336.30, needs to breach. I'm not getting too excited about gold because it's still weak. Needs to breach where we are, literally where we are now, and another $5 or $10 above that would show some interest. Other than that, we could be going back down to the 3,300 level on gold. So there we go. Oil, we did have a oil position open. That's still open. Our stop loss is up here now. Hasn't been impacted, but we've got a bit of a tweezer top there yesterday formed here on the daily time frame on UK oil. So back up, might pull my stop loss off a bit, but again, that's another one that's in the money still. And we went to 73.50 before we turned lower yesterday, and on Wednesday. 20-day moving average now at supporting us at 70.50 on UK oil. The one we talk about more often is US oil, and similarly move up and then move down. Tweezer top here at this tariff level we talked about at $71, and the key $70 level is where we sit at the moment, breaking out of the box we were in, the rectangle we were in here on Tuesday. With a big positive candle following Monday's rise to the upside. So there we go. Non-farm payroll, a big mover for a change. Dollar weakening. Let me just bring in the calendar again to review it, and then we'll go through the month as well. Unless some of you have got something else you want to talk about, obviously let me know. So where's my calendar gone? It's that one. I've closed it down, didn't I? You fool. There we are. That calendar for today. I'll go to next week in a minute. My filter's still held. No, they haven't. I've got everything. Not everything. Actually, let's find the big ones. Okay, so for today, so there's our key high impact numbers. Unemployment rate staying at 4.2%. And the headline 73,000 from 110, 106,000, and big miss for payrolls. Trump's just tweeted or sent out too little, too late. Jerome, drop the rate. Growth slowing, consumer spending waivers, as we've seen in the data last week as well. So, you know, there's an argument perhaps for moving it. We'll see as the trade impact, or the impact of the tariffs, how in fact inflationary they will be. Let's just have a quick check, see if that CME market has updated itself. Yeah, so there's a 69% chance now of a rate cut, or 70% chance now of a rate cut in September, from 37% yesterday. So back to where we were last week. I mean, it could all flip around again as well. And presumably 100%. Oh, sorry, you can't see this. Yeah, so that had obviously that's updated since the non-farm payroll. You see there, because it's there we are. It's updated 15 minutes later. So it's still obviously 15 minutes delayed, but you can see the impact of the non-farm payroll. So the surprise has taken the expectation for a cut to just shy of 70%, 68.9 for September, and the October one I would guess is about 100, if not, I know 100 again. So that's that. So we've got, what's that? That's 89% chance of some sort of cut by October. Nearly 40% chance of 100 basis points. Sorry, 50 basis points from where we are at the moment. So pressure politically and potentially data-wise on the Fed to actually act, if that is a number. Again, this could be the outlier the other way around, so we could be revised back the other way, but the shock is what's really spooked the markets. This huge variance, say from 147,000 to 14,000, private payrolls from 74,000 to 3,000. That's really freaked out the market. The wider unemployment rate ticking up, and the unemployment rate confirmed also rising. You see, it was 4.1 last month up to 4.2. So, but not better, not worse than expected. Whereas the private payrolls were worse. The headline was obviously worse, and then the revision last month was very, very significant. So, quite a shock and quite a volatile non-farm payroll deals like it was back in the old days. So yeah, big old mover there. So let's just have a quick review of July for markets. So let's just let's start with Bitcoin. Let's go back to our daily chart point. There we are. So we closed yesterday here at 116,500. We'd started the month down here, so it was ahead of our breakout. So it's been a good month for Bitcoin as well. We started the month down here. In fact, we opened trading for July at 107,000. We went all the way to 123,000. So it's been another positive month for Bitcoin. And what we've seen since the rapid rise in the first week is this consolidation we've been saying since the middle of the month here. The all-time high was hit here on the 14th, and then we sort of slid sideways. So we're consolidating, and now we've dropped off the end a bit here. So confirming perhaps the the decline in the oscillators. So what we were looking for was a break of the 20-day moving average. That may be happening today. It's too early to tell here on this daily time frame, but you can see we've been looping down all week. Next support is really this significant level, which was our previous all-time high zone between at 109,000, but above that is the top of the intraday high, which took us to 112,000. So that's the next big support area if we come under where we are now. But it looks like that's continued to drip down. Watch the weekend trading for any further signs of a weakness. The weakening dollar hasn't helped Bitcoin today so far. So strong, good, positive month. We've given some back in the last week of this long extended 5-week month, but still positive for the overall for Bitcoin for July. Going into August, watch 112. Obviously, watch the all-time high 125,000. Both of those could be tested anytime soon. The oil market. Let's stick with the US oil because it's one we're really talking about again. Obviously, the vagrancies of the geopolitics, the Iranian strike or the Israeli strike on Israel in the middle of June spooked markets, and then we came thumping down in the middle of June, and that continued really. That was the consolidation phase we saw through July. So a counter to Bitcoin slipping in the last week of July. Oil actually lifted quite strongly here, starting on the on Monday on the 28th, and lifted through the rest. Has lifted through the rest of the week, topping at $71 and just about holding $70 today. But really, the key support now is that top of that channel at $69 if this rally is going to continue into August and the final 4 months of the year in September through to the end of the year. So here on a daily basis, the 20-day sits at $68, and the 50 days now has moved over the $67 level. So oil this week has remained bid and having been very much sideways, consolidating for July. Let's not do the crosses, let's do the majors. Obviously, the major story, let's just use euro as an example, was the let's finish just make up. Where's the first of has been the July's here, isn't it? There we are. There we are. Absolute top there's the zoom this in a bit. There's the month here. So that's the last trading day of June. Now we closed June at 117.86.7. First day of July we went even higher. Let's just put that on there. That's the first day of July, or that's the last. Let's get it technically correct. That was so June closed there. This is today, and July closed here actually. So the weakness of the dollar during this during 2025, basically here we are down here at the beginning of the year. Here, this is the orange line. Here's the beginning of the year. So we're down here. We were all at 102. People were talking about parity, and we rallied all the way to 118 from 102. And the dollar has come back again, as I said earlier, particularly in this the last 2 weeks of July, but particularly in this final week of July. So we moved up for all these months, and we've come back quite aggressively in 1 week. So as ever with most markets, we go up quite slowly, we come down quite aggressively, and it's been a very aggressive last Friday and first few days of this week for the dollar strengthening. That's gobbled up the major last leg down today because that's the payrolls. So the dollar strength, as many were saying, I think we mentioned it earlier in the week about how long can it last? Is it going to last? It looked a bit too a little too aggressive to move down. We've actually come back, so we're back to currently 115.50. So 116, where our 50-day moving average sits. 116. Sorry, 115. 75 and 116, where the 20-day moving average sits, are the two key upside targets to take the euro back into a bid mode against the dollar. So again, it's it's too quick of a move. But again, it could all disappear if these numbers are talked away or talked through. But that's a major shock, and it's going to be a while before that to happen. So dollar overall had a better July than it has for many months. So it's had a positive July overall as we opened. That's the 30th, yeah. As we opened the month up here at 117.92 and closed the month down here at 114. So 300 plus move for the dollar against the euro for July, and similar against all the other currencies also. Aussie got as high as 65.20. Sorry, 66 it got to, didn't it? I'm talking about 66. No, over 66, in fact, we got to. But again, this week has been a significant decline from the recent multi-year highs, and back to test the 64 zone. But 65 is the key pivot area, key resistance area to the upside, and we're at the top end, back at the top end of that, thanks to payrolls. So 65 still plays a key role for the Aussie dollar pair going forward into August, as you might expect. For CAD, it was 138. It was a sort of a step too far. We were over it on Wednesday. We come back through it here today. But again, another one that's burst out of its July channel. So again, very much sideways action with a support at just shy of 135.80, under 136. The top of the channel at 137.50, and the breach, the run to 138 is, I say, is given back its gains on Wednesday and Thursday today, as we trade at 137.80 at the moment. Swissy, again, the best mover this year against the dollar. We're looking at, beginning of the even into the middle of the month, I was still looking to test this new low here. We pushed on July, but you can see here that's the opening day of July. It looked like we were continuing down. Didn't happen. The low was significantly above that at 79.15, and then we've continued to rally last week and this week but again, giving some back, and we're now back under the 50-day moving average, but still supported by the 20-day moving average. So that's looking potentially vulnerable. But we'll see. That support zone through there holds, and that's looking like a relatively strong area. The yen obviously got different connotations going on. The politics this month hasn't helped, but again, July the 1st low here was all the way down at 142.73. So it's been a stellar month for the dollar. Yen hitting highs yesterday, ironically, closing at highs, but giving all of that back, all of yesterday's gains and all of Wednesday's gains back today. So we've come back, crashing back through 150, and we currently trade at 148, having given up 149 and 148.50 as well. So a very significant move down today for the dollar against the stronger yen, but we are still bid to the upside. The 20-day moving average sits at 147.57, and the 50-day sits down there at 145.70 as well. So the rally from the lows of July is still valid and still in place, even though we had such a big shakeout today. Currently, obviously, that candle isn't complete, so we can't make a decision on what's happened today just yet. The Kiwi 61 was a high we got to at the beginning of the month. Again, we've looped lower, retraced, and then looped low again. One we've traded quite a lot this month, but 59 has been breached for a day and a bit, and then we've rallied on the non-farm payroll today. So 59 key support area. And again, as you can see, a breach of this during August, and there's a lot of fresh air below 59, taking us all the way down to this April spring low at 55.25. But again, the recovery was very, very strong, and it was a horrible, obviously, on the back of the tariff story. So that's our next low there, where that stop loss level is there. You see that through there, around about 58.25 is the next big support area. If 59 gives way for the Kiwi, but again, dollar this week very bid against the Kiwi. 20-day moving average is all the way up there at 59.70. So plenty of room there, plenty of pips in play on that one as well. Euro we've already talked about, and sterling continues to be dollar against sterling continues to be one of the better movers. So again, July the 1st high here took us to 138 into 138. We never actually got over 138, I don't think. And today we went all the way down before the payroll numbers came out to 131.50. It's already been tested. So that 132 area we were talking about earlier in the week has been breached, and another 50 points earlier this morning. We're now back through the 132 area, and we're trading at 132.90, having to go at 133. So the downtrend is still very much in play. The 20-day moving average sits at 134.30. So the down story we talked through this week has played out really nicely through the extended fib level yesterday, and then we sort of bounced a wee bit today. But so the downtrend is still very much in play, regardless of today's bounce up. And 130 is the next downside target if we breach 132 on an end of day basis, which we couldn't yesterday or the day before, and we've seen significant buying there. So this looks like where some significant bids are placed for cable at 132 as we go into August. But again, it's been a much better month for the dollar against sterling than it has been for a very, very long time. All the rest of the year, as we see here, all the way down here in January, massive rally, and we are now moving down, some significant legs there in cable forming some nice trending diagonals there. So very much in play. So this is a simple retrace of this big, consecutive. What's that? 1, 2, 3, 4, 5, 6 day consecutive fall, 6 consecutive days, and we've bounced here on the 7th day. So it's the biggest, significant follow through fall for a long time. You see this leg here, 6 consecutive days down. It ruptured here. This is longer leg down, but we were ruptured with an up day and up day. Got a doji day, up day here. So very, very significant decline over the last 6 trading days into yesterday for sterling. So there we go, dollar. Will it continue its rally in August? Possibly, but it certainly doesn't look like it'll be as aggressive as it was in July. But who knows? It's only it's not for me to tell the charts to tell us what's going on. Indexes continued, as we said, literally yesterday, the final day of the year. Final day of the month, was giving up some of the gains, but we'd had gone through these all-time highs this month. So again, another strong month for stocks. The earnings season, we had the biggest week of this week. Well over close to 60% of companies have reported now. I think it actually might be more than that when today's out. But Amazon, Apple weren't as bad as many were expecting last night. They did okay. Some quite good iPhone sales. It was Amazon that really disappointed last night. So I don't know what their stocks are trading at the moment, because we're still not yet open. It's only still 10 minutes to the open, but we'll have a look at what their stocks are looking like. At the moment, let's have a look. I think we were down. Amazon was off. It's off 7% pre-market. Amazon, very disappointing. And Apple, PPL, Apple was, I think, is up. No, it's also up 2%. Amazon off 7%, and Apple up 2%. Having very much underperformed the other major tech majors. So the major tech companies have all reported blowout earnings. Certainly Meta led the gang. Microsoft was pretty good as well. Apple was much better than many people had feared, to be honest. And Amazon disappointed, especially their cloud business, what I was reading this morning. So where are we? Well, we are still relatively bid. First signs of weakness here in the Dow. We are under the 20-day moving average yesterday, and we're down again today. So a breach of the 50-day here at 43,468 today will be a big question mark. But at the moment, that would have triggered short last night on this strategy. As you can see here, it didn't last long last time we went under the 20-day. It was a bit of a retrace, and then it was out. So that was a losing position. Let's see what happens if that has actually turned short. Certainly the longs have closed out on that breach of the 20-day moving average. The more conservative positions will be looking for the 50-day at 43,489. So call it 43,500, a clear line in the sand for the Dow going forward here on this derivative chart. Let's do the American marks, because the first one will come back to Europe. Dow, sorry, I was just using the Nasdaq as just showing you the strength of July. July's been again another strong month, angling up nicely, fairly steady angle on that chart, hasn't it? We've been gained, so don't panic. Two quite significant sell-offs the final day, and again today on the back of the payrolls, perhaps expected action in July after all from the Fed, as we are now testing the 20-day moving average. In fact, we're currently trading under it, aren't we? So it'll be interesting to see where that finishes today. But again, every time we've gone into the 20-day in this all-star stellar rally, we've been bought back here since the beginning of May, end of April time. We've been over this 20-day moving average. So from the hiatus we had at the beginning of April, as we were going that way, we've been going that way ever since. So first indicator has been getting breached here at 23,000. The 50-day sits there at 22,700, where my stop loss was from something back in the 9th of July or something. So 22,000, as you can see there, 22,003 or whatever that is now, 375 is the key support area for the Nasdaq. So if this break is confirmed today and Monday, we could have a move down into this zone next week and into August, or some consolidation. So remember, volumes tick lower in July, and they tick lower again in August as well. But you can see there's little diversion there. We've got flat MACD here, but it's been flat for months, so it's difficult to call that as a divergence. Obviously, a clear move down yesterday and today at the end of the month, and the Nasdaq 100. And the S&P 500, similar 2-day down, but again, another nice move up for July, and into overbought area here. You see on the RSI, and a significant decline the last 2 days as we take today before we break in the 20-day moving average. So ones to watch into the end of the day. If we just tick this up to the weekly chart, though, it gives you a bit put it a bit more in perspective. You know, that is still very, very well bid. We've had a down week for the first time in a long time. If we close where we are now, and it's a negative engulfing week, so that maybe the final week of July was the top of the market for now, at least. So we may be cooling into August, which is not untypical. And as you can see, the big round 6,200 is the next big support area, and there's 6,100 just below. Oh, that's 6,000 in that one there on the weekly chart. Yeah, so that's 6,200, the big support for August. Watch that as we go through August and into September. But again, stocks, as you can see here, really well bid, not overbought here on the weekly chart. Nice move up here still on the MACD. We've got a weaker histogram here this week because we've had a down week, but that's still bid, nothing to get too worried about. Come back next Friday, see what it looks like. You know, on these higher, if you're a weekly, just once a week checker of the markets, that's still bid. And we've had a good July. We've given some of it back in this final week of July, but this is week 5, 4, 3, 2, 1. We started here in July, and over here under 6,100. Under 6,200. And we got as high as 6,400. So, you know, it's still 300 odd pips, 200 odd points in the good for the month of July for the S&P 500, the world's most significant stock market. So if that's gained, you know, a good 200 odd points on its 6,175 opening for the month, that's still, you know, nothing to get too worried about. That's a positive, it's not a negative. So a bit of a down week this week. It was probably due, to be honest. The size of the down might be the question. Some might be looking at, but anyway, stocks remain bid there in the US. Across the pond in Europe, the DAX trading currently at 23,500. A bit more of a consolidation for July. That's the weekly one on for the DAX. Let's go to the daily, show you the month. Again, there's that extended consolidation on the daily time frame. July started, and we're sort of back to where we were really at the beginning of the month. So July was the end of, yeah, there we are. We were here, and we're actually down, interestingly, for the month for the DAX. So the DAX went to a new all-time high at the beginning of the month, had another spike higher this week as well. But subsequently, we've moved down yesterday and again today. So we're actually down for the month on the DAX. The FTSE still holding 9,000. So unlike the Dow, unlike the DAX, its German counterpart, the trade deal was done at 10% a while ago. So obviously the EU deal was done, or the handshake, the outline deal was done last Sunday, and less beneficial numbers. So the FTSE is benefiting both from the weakening sterling this month we've seen this week. Sorry, these last 2 weeks, I should say, this month. But it's still holding above the key 9,000, or what is now a key 9,000 level. And interestingly, this week, the 20-day moving average has moved above the 9,000 level for the first time ever, as we've got to all-time highs on the FTSE earlier this week. And it was yesterday, was it? Even yesterday, the FTSE didn't actually make any news in the United Kingdom. So again, if we just tick this up to the weekly chart, there's our strong 6-week rally, and again, bit of consolidation this week, but positive for July overall. So there we go. And finally, I'll do gold as well. Gold's just very, very much sort of, oh, it's messy, isn't it? Let's try and fit that. That's because that's weekly. It's extended that daily sort of consolidation zone. Let's just let's see. As we let's make these down. As we say, yeah, we talked about this earlier, didn't we? The 3,300 area. So that's really, as we're going forward, the down leg, if it continues, would take us to 3,325. This fib extension, but I say that's been the key level this week. That 3,275 level, which is the low we had at the 27th and 28th of June. It's been copied here, the 30th and the 31st of July, and gold bounced up today on the week non-farm payroll data, but we're still really capped at that 50 and 20-day flat moving average. So we'd like to see this continue to move, which it has been since we've been speaking. So 3,350. We close here. That's going to be a very positive day for gold. So again, I'll come back and look at that later on tonight. Okay, so before I wrap up, I've been here for over an hour and a half, hour and 50 minutes. Well, wow. Oh dear me, no, I'm tired. So let's just have a quick look at not me to do that. Next week. Next week's quieter. It's absolutely, well, any week would be quieter after this blockbuster week. So next week is the first full trading week of August, and we have oh, it's a bank holiday this weekend. Yeah, it was a bank holiday this weekend in the UK. It's not, is it? I don't think that's correct, actually. I think bank holiday is the end of August. It's not. Pretty sure it's not bank holiday weekend on. It's not bank holiday Monday in the UK. That's wrong. So don't believe everything you see on the internet, my friends. So yeah, a relatively quiet week next week. The PMI start off because it's the first week of the month. So we've got services on Tuesday out of the US is the key data for Tuesday, and non-managed. So we got the Standards and Poor's, and the more important ISM manufacturing and non-manufacturing PMIs on Tuesday, along with the private oil inventories. Wednesday brings us the official oil inventories and a speech by Ms. Daly from the Fed. Again, seems it's a much quieter week. Apart from, so PMIs are really the point of interest next week. Thursday brings us the Bank of England, and they may be looking to remember the Bank of England MPC has been much more divided than many of the other central banks. So we may see pressure for cuts. The data's been pretty weak in the UK, so we may see pressure ramping up into the Thursday announcement, I should say, from the Bank of England on Thursday. So watch that. We'll be live for that on Thursday next week. Obviously, the weekly claims as well coming out later on Thursday as well. Big strong week this week. Obviously, non-farm payrolls, big question mark over that. But the weekly claims continue to show the robustness of the US market. And again, lots of analysts were talking about, even if it's confirmed at this 73,000 level, it's just been reported in the last hour or so. That might not be as spooky as many as it might suggest, simply because of the evaporation of the migrant workers in the US as well. So it still might suggest a relatively strong US market, although, as we've seen, the consumer data this week showed a bit of a ticking up in the PCE, and also weakening of the consumer. So it may be time I mean, the pressure may be increasing on Powtact earlier rather than later. But really, Bank of England in focus on Thursday with weekly claims out of the United States, and then Friday, I think, is the it's the Canadian jobs data, because it didn't come out today, did it? So it's Canadian jobs next Friday. So much quieter week next week to kick off August, the holiday month, if you like. So, but plenty of opportunities still. I hope you have benefited from the movement today, and also the movement this week and this month. If not, let me know why, and we're here to help, guys. So we are the proptrade.com. Our trades, we are open, transparent, and the grown-ups in the room, as some of our marketing has been saying this week, which I really like that phrase. And we are as good as any prop company out there, if not better than an awful lot of them, my friends. So come and give us a try. There's nothing to hide. Friday is payday for our clients. There have been some really nice comments today on our Discord group. Discord is where all our chat goes, where I put all my daily trades. Our Discord group. If I just go to the success stories and achievements, these are the guys posting. These are the ones that want to go public and tell people, and they're not massive numbers, but they are happy with our service. Really happy to get my first payout from the prop traders, Harrington. It's only $200, but $200, it's money out. It's not money. It's not money going away. It's process, guys. If you could, Harrington. Krishna, I don't know if you're here, but if you can do it, if you can make $200, you make $2,000, you make $20,000. It's all about process, my friend. So keep on going. Same with you, Akush. Data 200, 3,000. Here we are. Kumar, 2.5, 1,100, 1,200. So just keep it going. This is where all our chat takes place. This is where we support you. Johnson is our one of our moderators, and he's always there helping you, along with his colleagues Thompson and Katzen are our main support team. Okay, so if you want an account, here's our website, the proptrade.com. Our most popular account is the standard, and it's the $25,000 account. It costs $175, but there's always some offers on. And if you're brand new to us, not used us before, if you type in new 25 into the coupon code, gets you a 25% discount off on already well-priced $175 $25,000 account. So just over $130 gets you a $25,000 worth of equity to trade these simulated accounts. Step 1, you're looking for 8%. That's come down. Step 2, 5%. Don't lose more than a maximum of 10% on each of the phases. And then you get to your funded account. You get your investment back on the second payment of the funded account. So the $131 you get back. And you also then, the big thing is, you trade that account minimum of 3 days. And any profit you've made at the end of those 3 days minimum, it doesn't have to be 3, it could be 3 months. It's up to you. I mean, some people seem to be in a massive rush in this business. God only knows why, because that isn't what it's about. The markets do what the markets do. They're always going to be there. There's no rush. Get your, your education, your system, your process ironed down and practice with these accounts. Not risking too much. A few $100s to get these big equities. That's the way to get it. And then once you've cracked it, these funds become real money. You saw the guys getting paid there. They can build up very, very quickly, and the sky really is your limit. So 80% of profits will be yours, along with your refund of your payment. So come and join us. Give it a go. All right, I'll see you off. Spoken for far too long today, but it's been a very, very interesting and non-farm payroll day for a change. There's no comments from anybody. An hour and 13 minutes. I'm going to wrap this up now. So have a great weekend. Stay safe. I will update the Discord group with how we have done for this week and for July. And I'll just check out. I don't think I put last week's results up either, but I will do that over the weekend, if not later today. Okay, so on here, basic trading strategies is where we put all the actual trades we do on each night. So, and I'll copy it onto the general chat area as well. So there we go. Take care, everyone. See you soon. See you on Monday.